Silver is not just a precious metal anymore, it has become a strategic industrial resource tied to technology, energy, and national security. Over the past few years, global data has shown something unusual. One country has been accumulating silver at a scale that appears disconnected from normal industrial demand. At the same time, global inventories are tightening. Premiums are rising in physical markets, and supply chains are showing signs of stress. This raises an important question. Is this just normal industrial consumption? Or is something larger happening beneath the surface? To understand this, we need to break it down clearly using 3 parts. What silver accumulation means, how normal demand differs from strategic accumulation, and what current global data may be signaling. Silver accumulation refers to the large-scale purchase, import, or stockpiling of physical silver by a country, institution, or entity beyond immediate industrial needs. There are 2 main types. 1. Commercial demand. This is normal usage. Electronics manufacturing, solar panels, jewelry production, industrial tools. It is price sensitive, meaning when silver becomes expensive, usage usually decreases. Strategic accumulation. This is different. It happens when a country buys or imports silver regardless of price, stores it for long-term national use, treats it as a strategic resource like oil, gold, or rare earths. It is price insensitive, meaning even if silver becomes expensive, buying continues. Why silver has become strategic. Silver is unique because it sits at the intersection of renewable energy solar panels, electronics and semiconductors, military and defense systems, advanced manufacturing. Unlike gold, silver is heavily consumed in industry. Once used, it is often not recovered efficiently. This creates a problem. Demand keeps rising, but usable supply is limited. Now, if a major industrial country begins accumulating silver aggressively, it can gradually tighten global availability. The unusual import pattern. In recent years, silver import data shows a consistent pattern of rising annual imports, continued buying even when prices increase, reduced exports, increasing domestic stockpiles. Normally, when prices rise significantly, industrial demand slows down, but in this case, imports increased even during price surges. This is the first major signal that something beyond normal commercial demand may be happening. How normal versus strategic demand behaves. Example A. Normal industrial behavior. When silver prices rise sharply. Solar manufacturers reduce silver usage per panel. Electronics firms switch to alternatives like copper. Companies delay or optimize production. Result: demand decreases. Example B. Strategic behavior. When a government prioritizes a material, imports continue regardless of price. Stockpiles increase. Domestic supply is prioritized internally. Exports are reduced or controlled. Result: demand increases even when prices rise. Historical case studies. To understand current patterns, it helps to look at past examples. Case study 1. Rare earth elements. Over a multi-year period, domestic production increased. Exports were restricted. Foreign mines became less competitive. Stockpiles were built internally. Eventually, one country gained dominant control over global refining capacity. Export restrictions were used as geopolitical leverage. Lesson: early accumulation leads to long-term market control. Case study 2. Gold accumulation over several years. Official gold reserves appeared stable, but physical withdrawals from global markets suggested higher demand. Later, large reserve increases were announced. This created a shift in global reserve perception, increased strategic importance of gold holdings. Lesson: accumulation can happen quietly before being revealed. Case study 3. Industrial metals stockpiling. In past commodity cycles, large stockpiles were built during stable prices. Exports were later reduced. Global markets experienced sudden supply shocks. Lesson: Supply control often begins before markets realize it. Current silver pattern: what data suggests recent trends show? Multi-year growth in silver imports. Rising imports even during price increases. Declining exports. Increasing domestic consumption and storage. Strong physical demand indicators in exchange withdrawals. At the same time, global inventories in Western storage systems have declined. Physical premiums in key markets have increased. Delivery times for industrial users are lengthening. For key mechanisms affecting global supply. Mechanism 1. Inventory drain. Large-scale imports remove silver from global circulation. Result: less metal available in international vaults. Reduced liquidity in physical markets. Mechanism 2. Rising physical premiums. When physical demand exceeds supply, buyers pay higher premiums for delivery. Local markets trade above global benchmark prices. Result: clear sign of tightening physical supply. Mechanism 3. Industrial allocation priority. When domestic demand rises, internal industries receive priority access. Foreign buyers face delays or reduced availability. Order sizes increase and delivery times extend. Result: supply becomes segmented and restricted. Mechanism for refining bottlenecks. If a country controls large refining capacity, more output is processed domestically. Less refined silver is available for export. Global supply chains become dependent. Result: structural dependency develops. What market behavior indicates? A key insight comes from comparing expected versus actual behavior. Expected in normal markets. Higher prices gives lower demand. Stable imports, balanced exports. Current observed behavior. Higher prices gives higher imports. Rising accumulation, declining exports. This mismatch is the strongest signal that demand may not be purely commercial. To possible future scenarios. Scenario 1: gradual tightening, most likely imports continue steadily. No formal export restrictions. Physical premiums remain elevated. Supply gradually tightens over time. Outcome: slowly rising prices. Long-term structural shortage. Controlled market adjustment. Scenario to supply shock: high impact scenario. Accelerated accumulation. Export restrictions introduced. Rapid decline in global availability. Outcome: sharp price spike. Supply chain disruptions. Emergency sourcing by industries. Market repricing of silver. What to watch going forward? To understand which scenario is unfolding, key indicators include monthly import trends, export volume changes, exchange inventory levels, physical market premiums, delivery times for industrial buyers, policy updates related to strategic materials. If multiple indicators tighten at the same time, it signals increasing pressure on global supply. Conclusion: silver is no longer just a passive industrial commodity. It sits at the center of modern technology, renewable energy, and global manufacturing systems. The key takeaway is not certainty but structure. There are two competing interpretations. One sees rising imports as normal industrial growth. The other sees a pattern consistent with strategic accumulation behavior seen in past commodity cycles. The difference between these interpretations matters because it affects how markets, industries, and governments prepare for future supply conditions. Final feedback. The data shows strong demand divergence from normal price behavior. Physical markets are showing signs of tightening supply. Historical patterns suggest strategic accumulation is possible but not confirmed. Future outcomes depend heavily on policy decisions and global demand pressure.